In a move that sent shockwaves through the global economy, the Trump administration unveiled a sweeping new policy, a 10% tariff on all aluminum imports. Officials defended the decision as a matter of national security, insisting that a robust domestic aluminum sector was crucial for both defense and economic self-sufficiency. The intention was straightforward: revitalize U.S. aluminum manufacturing, safeguard American jobs, and cut back on foreign dependence. Yet the ripple effects of this policy would extend far beyond the nation's factories. The tariff aimed to level the playing field for American producers, giving them a competitive edge. But for industries that rely heavily on aluminum, especially those for whom it's a fundamental material, costs began to climb almost instantly. Beverage makers, in particular, felt the pinch right away, since aluminum is at the heart of their packaging operations. For beverage companies, aluminum cans are more than just packaging. They're the lifeblood of distribution, carrying everything from sodas and sparkling water to beer and energy drinks to millions of customers daily. The material's lightweight and recyclability have made it the industry standard for decades. The new tariffs put pressure on the fragile economics that keep these drinks affordable and accessible. Industry giants like Coca-Cola and PepsiCo suddenly faced a new challenge: increased production costs that threatened to disrupt their carefully managed supply chains. These companies had to rethink not just their aluminum sourcing, but also their entire approach to packaging and logistics. Overnight, the expense of making a single can of soda shot up. Companies were forced to make tough decisions. Should they raise prices and risk losing customers, or absorb the extra costs and watch their profits shrink? Some began searching for alternative materials or more efficient manufacturing techniques to soften the blow. Would they risk customer loyalty by hiking prices, or innovate to keep costs in check and protect their market position? The race was on to find inventive solutions, from redesigning cans to ramping up recycling efforts. This challenge sparked a wave of strategic shifts across the sector, with major implications for pricing, business models, and even environmental practices. Companies started to weigh the advantages of recycled aluminum, while environmentalists raised concerns about the impact of increased domestic mining. The aluminum tariff quickly became more than just a trade measure. It ignited a broader transformation, fueling debates about globalization, manufacturing, and the future of American industry. The groundwork was laid for a dramatic evolution in how beverages would be packaged, priced, and sold across the country. As companies adjusted to this new reality, consumers too would soon notice the effects of this sweeping policy in their everyday purchases. When the U.S. government imposed tariffs on imported aluminum, Coca-Cola responded swiftly and decisively to protect its business and its customers. The company recognized that these tariffs would significantly increase the cost of producing its iconic aluminum cans, threatening both its profit margins and the affordability of its products for millions of consumers. In response, Coca-Cola unveiled a comprehensive plan to shift a greater portion of its packaging from aluminum cans to PET plastic bottles. This wasn't just a minor tweak. It was a major strategic pivot designed to adapt to rapidly changing market conditions. The primary goal of this move was to shield consumers from sudden price hikes and ensure that Coke's products remained accessible and affordable on store shelves. By increasing the use of plastic bottles, Coca-Cola could better control costs and maintain its competitive edge. The company also explored sourcing more aluminum from domestic suppliers, hoping to reduce reliance on imports. However, the sheer scale of Coca-Cola's operations meant that U.S. supply simply couldn't meet the massive demand required to keep production running smoothly. While modest price increases were considered, Coca-Cola's main defense was to rebalance its packaging portfolio, using more plastic to offset the volatility and unpredictability of aluminum prices. This approach allowed the company to remain flexible and responsive. CEO James Quincy explained that, although packaging is only a small part of overall costs, Coca-Cola's immense scale and global reach gave it a level of flexibility that smaller competitors simply couldn't match. This scale allowed the company to absorb shocks and adapt quickly. Thanks to its robust margins and extensive distribution network, Coca-Cola was able to absorb much of the impact from the tariffs without causing major disruption to its operations or supply chain. This packaging pivot was not just a reaction, but a calculated business move. It demonstrated the agility and foresight of a global giant, showing how Coca-Cola could navigate economic and geopolitical shifts with confidence and precision. By communicating transparently with investors and the market, Coca-Cola reassured stakeholders that it had a clear, actionable plan in place to weather the storm and continue delivering value. The shift to plastic wasn't merely a substitution of materials, it was a strategic deployment of the company's operational flexibility, leveraging its resources to adapt to new challenges. Ultimately, this move showcased how industry leaders can turn a potential crisis into a manageable adjustment, keeping products on shelves, prices stable, and customers satisfied, even in the face of global uncertainty. Despite fears of pricier sodas, the aluminum tariffs had a surprisingly mild effect on what consumers paid at the store. Coca-Cola's healthy profit margins and strategic shift to more plastic and glass packaging helped absorb the cost increase. By choosing materials unaffected by tariffs, the company stabilized production expenses and kept retail prices steady. The beverage industry's scale and supply chain flexibility insulated shoppers from minor raw material fluctuations. As a result, the price of a can of Coke barely budged, and the aluminum tariff shock became more of a headline than a hit to the average wallet. The episode proved that for global giants, trade policy shocks don't always translate to higher prices for consumers. Strategic planning and financial strength kept the impact at bay. The beverage industry's supply chain is designed for maximum flexibility, allowing major bottlers to seamlessly switch between cans, plastic, and glass packaging as market conditions change or supply issues arise. This adaptability is built into their operations, with advanced machinery and logistics networks ready to pivot at a moment's notice. So, when aluminum prices spiked due to tariffs and global shortages, major brands like Coca-Cola and PepsiCo were able to quickly ramp up production of plastic and glass bottles. By shifting away from aluminum cans, they minimized disruption to their supply chains and kept their products on store shelves, barely missing a beat. This kind of operational agility is a huge advantage for large corporations. It lets them weather sudden cost shocks, adapt to new regulations, and keep their products flowing to consumers without major interruptions. Their scale and resources give them a buffer against market volatility. But for smaller companies and craft brewers, the story is very different. Many of these independent producers rely almost entirely on cans, lacking the capital or infrastructure to invest in new bottling equipment or alternative packaging formats. For them, the spike in aluminum prices was a much tougher challenge to overcome. Switching formats wasn't just a matter of flipping a switch. It required significant investment, retraining, and sometimes even rebranding. For many, it simply wasn't feasible or affordable, leaving them far more vulnerable to the sting of tariffs and rising material costs. The result? A widening gap between industry giants and small players. While the big brands could absorb the shock and adapt, smaller businesses struggled to keep up, with some even forced to scale back production or raise prices. This episode highlighted how broad trade policies, like tariffs, can have uneven and sometimes unintended effects across an industry, often hitting the little guys the hardest and reshaping the competitive landscape in ways policymakers may not have anticipated. Wall Street watched closely as the aluminum tariffs hit, but the market's reaction was calm. Coca-Cola's stock price held steady, reflecting investor confidence in the company's ability to manage new costs. Public reassurances from leadership and the company's proven flexibility soothed any jitters. Investors saw the tariffs as a manageable hurdle, not a crisis. The lack of panic selling showed that global beverage giants were seen as resilient, adaptable, and well-prepared for economic shocks. For the market, the aluminum tariff was just another problem for big companies to solve. Coca-Cola's pivot to plastic bottles sparked immediate environmental concerns. Aluminum is highly recyclable, while PET plastic has a much lower recycling rate and often ends up as pollution. The shift came as public pressure to reduce plastic waste was at an all-time high, making the move seem like a step backward for sustainability. With little regulatory push for greener choices, companies prioritized short-term savings over long-term environmental impact. The tariff, meant to protect U.S. industry, inadvertently encouraged more plastic use, an unintended consequence with global repercussions. The episode became a case study in how economic policy can clash with environmental goals. The true cost of the shift may be measured in plastic waste, not just dollars. Coca-Cola's increased use of plastic clashed with its public sustainability promises, like the World Without Waste campaign. The company, already criticized as a top plastic polluter, quietly adjusted its recycled content targets, drawing skepticism from environmentalists. The move suggested that when profits are at stake, sustainability goals can take a back seat. This disconnect between marketing and action fueled doubts about the sincerity of corporate green initiatives. Coca-Cola's response to the tariffs became a test of its environmental commitments. The choice to use more virgin plastic raised tough questions about whether sustainability is a core value or just a slogan. The aluminum tariff saga set a precedent for the entire beverage industry, showing how trade policy can reshape corporate strategy and sustainability. As Coca-Cola pivoted to plastic, other companies faced pressure to follow, risking a broader industry shift away from aluminum. The episode exposed the vulnerability of global supply chains and the value of operational flexibility. Smaller companies, unable to adapt as quickly, were left at a disadvantage. The real lesson: economic, environmental, and political factors are now inseparable in business planning. The industry must balance affordability, profitability, and sustainability in a world where every decision has ripple effects. The aluminum tariff was more than a cost issue. It was a wake-up call for a more holistic approach to business and the planet.